This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Let's go through and have a look at IAS 21. IAS 21 is all about foreign currency transactions and is split into two parts. So what we've got first of all is we'll need to look at what the standard refers to as the functional currency. To make it simpler, you can think about it as the home currency. So you are based within a particular country. How do you determine what currency you prepare your financial statements in? It's not such a simple scenario as you're based in the UK, we prepare the financial statements in pounds. You're based in America, you prepare the financial statements in dollars. You're based in Germany, so therefore prepare the financial statements in euros. Okay, we have to have just a little bit of rules and background as to what do we choose as the functional currency. Okay, once we've gone through and done that and understood the functional currency, we can then go through there, can't we, and look at how to record transactions in that functional currency if the transaction we enter into is in a different currency to our functional currency. So if I had a functional currency of the pound sterling and I entered into a credit sale with a company in Germany and that invoice was raised in euros, I would need to convert those euros into pound sterling before I then record the transaction, which did I say was a credit sale? So to debit the receivables and credit sales. So it's all about being able to translate the overseas transactions into that functional currency. Happy with that? That's it. Okay, so there's going to be some computational parts when we look at the translation, and the first bit that we'll look at now, that there's no computations at all, and that essentially it is knowledge and application within a question, so non-computational aspect. So what do we mean by the functional currency? The functional currency is defined as the currency of the primary economic environment where we operate. Quite fancy word, isn't it? It's where we P, okay? It's the primary economic environment. And that essentially means whereby you generate and spend cash. That determines your primary economic environment, okay? How do we generate the cash? So what are our sales in? How do we expend the cash? So what are expenses in? And we look at what the majority of the generation of cash and the majority of the expenditure of cash is in to determine our primary economic environment. Because don't forget, we're going to have lots of transactions going on, and some could be in different currencies to other. Okay, so we look at what the majority of those transactions relate to. You should go through there. You've got additional information in terms of factors to consider. In terms of generating cash, we're looking at our sales prices. In terms of expending cash, you're looking at your operating costs. So you're thinking there essentially your labor and materials. Okay. And then looking at the entity's finances. So when you're talking about your finance, you're talking there about your debt, you're talking about your equity. What is the principal currency that you raise your company's financing? Okay, so if you're a UK company, probably most of the sales will be done in pound sterling. You will pay your staff in pound sterling. The materials, the majority will be purchased in pound sterling. There could be some that are imported from Europe or America, so it could be in dollars or euros, but again, the majority of our sales are in pound sterling, so that's pushing us towards the pound as the functional currency. And if we are listed in the UK, our equity finance will be raised in pound sterling, and we'll also finance the business via loans that we have in the UK. Okay, so everything points towards the pound being our functional currency. So there's nothing untowards there. But maybe if you are a developing country, or you are a country whereby there is an unstable economy, then maybe what might happen there is that instead of invoicing your customers in your local currency, you might invoice them in dollars. you might import most of your materials and again pay in a stable currency, which is dollars. Okay, you may pay your local staff in the local currency, but the majority of your sales, the majority of your operating costs are in dollars. So therefore, even though you're based in a country that doesn't have the dollar as the local currency, you will choose the functional currency as being the dollar. I say choose, it's more likely it's determined by the standard to be the dollar. Okay, very rare that happens unless, as I said, you are a developing nation or maybe you have an unstable home currency. But most of the time, if you're in the UK, it's the pound sterling. If you're in America, it's the dollar. Okay, there you have it. In terms of the individual company accounts, how do we go through that and record these transactions? We look at how to look at group accounts in F2, so don't worry about that for now. We are just recording the transactions. So if I buy or sell goods today, I need to process a debit or credit today and convert the overseas currency into my functional currency. So what we go through and do there is we use the rate that is in place on the date. That is referred to as HR being the historic rate. Okay, so if there is a transaction that takes place on a particular day, you record the transaction at the historic rate, whether it's the initial transaction when you bought or sold the goods, or whether it is then the subsequent settlement of the cash, whether it's a cash payment or cash receipt. You record that payment or receipt at that historic rate, the rate that's in place on the date the transaction takes place. Okay, it makes sense, doesn't it? It's not rocket science. The next bit is a little bit more of a challenge, because what we then need to go through and do is we need to go through our full statement of financial position and look at the assets and liabilities and determine whether or not they are monetary or non-monetary, because the subsequent accounting treatment is different for monetary and non-monetary items. Monetary items, by definition, are anything that is readily convertible into cash. So for you and I, receivables, payables, bank loans, or even cash if you have an overseas bank account, that's a monetary asset. Okay, so let me repeat: receivables, payables, loans, and bank accounts. Okay, they are all monetary assets because they can be readily convertible into cash. Because they are readily convertible into cash and they are denominated in a currency that is different to your functional currency, what you need to do there is at the end of the year, you need to retranslate, and you retranslate there at the closing rate, CR. Okay, and with that translation, there could then be gains or losses depending upon whether the value of the asset's gone up or down, and similarly with the liability. Okay, what then happens is that any gains or losses that you have, they go immediately through profit or loss. Okay, then we need to think about your non-monetary items. Non-monetary items are items that are not readily convertible for cash. So the prime examples that you have are property, plant and equipment, investments, intangibles, inventory. Okay, property, plant and equipment, investments, intangibles, inventory. They're all non-monetary. They're not readily convertible into cash. Inventory will be converted into cash, but it needs to be converted into a receivable first. So it is deemed non-monetary. So essentially, everything that is non-monetary is everything above receivables, isn't it? Those non-current assets and that inventory current asset. So everything above receivables is essentially non-monetary. And because that non-monetary is not readily convertible into cash, it is not retranslated. Okay, so you leave it at its particular value. Okay, there is an exception to the rule. I would just be aware, however, I don't think it's going to be examined at this F1 level. However, unless that non-monetary asset is carried at fair value and you need to revalue it to fair value at the reporting date as part of the accounting treatment, not as part of a retranslation exercise, If that's the case, you go through there and you translate at the rate when the fair value was established. Okay, so you have your original fair value at the rate at that date. You look at your updated fair value and you use the rate that's in place at that updated fair value date. But again, I think that's just beyond the scope of the syllabus. Okay, key bit, remember, you have monetary, you have non-monetary. Okay, monetary, readily convertible for cash. Non-monetary is not readily convertible for cash. So inventory, PPE, investments, intangibles. Remember the treatment. Monetary, you translate and then retranslate. Non-monetary, you translate and leave, don't we? If there are any gains or losses that arise, they always go through to profit or loss. There's nothing specific within the standard, it doesn't say, but just note, if you have a trading transaction, so the receipt of cash from a customer, the payment of cash to a supplier, or if you have just a receivable or a payable from your day-to-day trading, any gains or losses there can go through operating costs. But if it's there to do with a financing transaction, so maybe an overseas loan, any gains or losses on translation of the overseas loan at the reporting date, given that it is monetary, it will be retranslated. They can go there through finance costs. Okay, but that just tends to be as a generally accepted practice as to what businesses do. Okay, so what we've got there is the question says, show how the transaction will be recorded in Jones's financial statements. So when we're thinking about the financial statements, we're thinking about the position statement and the performance statement. So profit or loss, isn't it? It says that within the question specifically that we have the functional currency. Is it there as the US dollar? So everything will need to be translated into the dollar. And it says it trades with several suppliers overseas and bought goods costing 400,000 dinar on the 1st of December X5. So you have, is it 400,000 dinar will need to be translated at the rate that was in place on that 1st of December date. So I think you can see there the 1st of December is a rate of 4.1, isn't it? It seems to be that those goods were purchased on credit because we then didn't pay for the goods until the 10th of January 20x6. So again, we'll need to go through there and consider, given that the year end is December, we'll need to look at what happens at the year end before we then go through and have a look at what happens. Is it there on the 10th of January? Okay, remember the year end, we use our closing rate to retranslate any monetary items with gains or losses through profit or loss, isn't it? Okay, so let's go through, pull it together, see how we get on. So the transaction took place, was it on the 1st of December X5, wasn't it? So we're looking there at our initial recognition, aren't we? We bought some goods on credit. So let's get the journal entries first before we think about the numbers. So we debited purchases and credited payables, didn't we? Okay. The amount of money that we had, was it these 400,000 dinars? It's 4.1 dinars to the dollar. So I think that works out, is it 97561? There we go. So that's your initial recognition. Debit purchases, increasing the expense. Crediting payables, increasing your liability, isn't it? Okay. What about the subsequent accounting treatments? Because what you've got there is we need to consider what happens at the 31st of December X5. Because the 31st of December X5 is our accounting year end, isn't it? Okay. So what we need to do there, remember, is we need to go through the statement of financial position and identify your non-monetary and your monetary balances. So monetary are things that are readily convertible for cash. Non-monetary are not readily convertible for cash. So the non-monetary item that we have here is your inventory. So we made a purchase, didn't we? So we debited purchases. That then falls into your closing inventory at the end of the year. So your inventory, remember, we do not retranslate that there. So that will stay at the 97561. Okay. So we do not retranslate, do we? However, yes, you're on it already. The payable is monetary, isn't it? So we retranslate it. We retranslate that 400,000 at the closing rate, which I think was 4.3, wasn't it? So my payable at the end of the year needs to be 93023, doesn't it? Okay. Previously, it was 97561, wasn't it? So what you have there is you have a reduction in your payable from 97561 to 93023. Does that give me 4538? Okay. So that's the movement in the payable, isn't it? Yeah, we've retranslated it. It will be shown on the statement of financial position at 93023. However, how do we go through there and record it using journal entries? Well, I need to go through there and debit my payable, don't we? As we are reducing the payable with 4538. And I credit, well, it's a gain, isn't it? Because credits are good in the statement of profit or loss at 4538. Okay. So on the statement of financial position, I think it's important that you recognize that you have a liability of 93023. And then in the statement of profit or loss, you have a gain. Okay. Again, that could be one of those type of questions with a drop-down list, whereby you have to determine whether it is a gain or a loss at the end of the year and input the journal entry or input the number as well. Okay. Then just to go through and finish it off, we've got there what happens is it's on settlement, which I think was on the 10th of January X6, so quite soon into the year, isn't it? We need to record the transaction at the rate in place on that date. So what happens there is that your payment that you make is the 400,000 dinars, isn't it? The rate that's in place on that date, I think, is 4.4, isn't it? That's the rate today. It's referred to as the historic rate. So that's the rate today. So that gives me there, is it 90909? Okay, that's the physical amount of cash that you are going to pay. So I am going to credit the bank with 90909. I need to remove the payable. So I am going to debit the payable. Well, what was the last known balance on the payable? It was there, wasn't it, as 93023. So I debit my payable with 93023. You can see there that it doesn't balance, does it? Or at least I hope you can. If you can't, we're in trouble. And what you've got there, the balancing figure is a credit. That credit balance is 2114. That is an exchange gain in profit or loss, isn't it? So you have a gain on the statement of profit or loss. And the reason why it's a gain is because the exchange rates must have moved within our favour, i.e., the payable is reduced and we have therefore paid less. Okay, excellent. I think what you'll find is you quite like foreign currency and IAS 21. There's nothing too difficult computation wise. Obviously, just be careful. If you have a debit entry on the exchange gain or loss, it is therefore a loss, isn't it? Through profit or loss. And I think in terms of determining the functional currency, there isn't a huge amount to consider there, is there? Okay, so there could be some really easy marks, I think, within the exam to do with your functional currency.